There's a couple different metrics by which you can measure just how cheap banks are. Here's one. Take a look. It's price to book. You can see book value. That's the inherent worth of a business. And assets minus liabilities. Bank of America is by far, using that metric, the cheapest. Its stock trades at just 0.28 times book value. Now, think of it as 28 cents on the dollar, roughly. Sounds pretty cheap. Well, the average for all the banks, by the way, is about 0.85 times. All right, well, joining us now is Charles Peabody, an analyst at Portales Partners, an independent research firm specializing in the financial services industry. He's a Bloomberg Best analyst for his research on Morgan Stanley. Charles, good to have you here on Street Smart. Let's start with Morgan Stanley, since you're Bloomberg Best on that particular company. That stock had a crazy up and down yesterday, peak to trough, or trough to peak, as it were, 20% in one day. How do you explain that type of movement?
Well, the volatility is largely because of all the uncertainties out there, whether it be their French bank exposure, their derivative exposure, maybe their exposure to joint ventures in Asia through Mitsubishi. People really don't know what's going on, so it'll be important to get the earnings out next week to help calm markets down.
Let's talk a little bit about the biggest factors now that are weighing down share prices. We have regulatory issues, right? We have real legal issues that are changing on a day-to-day basis. We have Europe, of course, and then there's just running a profitable business. Which of those do you rank as the biggest factor right now in the way these stocks are trading?
Well, Europe is by far the overreaching issue, but I think today some of the lagging performance of the bank stocks that your colleague referred to may relate to some of the litigation issues. Certainly the filing by both the U.S. and the New York Attorney General against Bank of New York Mellon on their foreign exchange trading, that's brought up the litigation risk issue again. But there's also a very important New York Supreme Court ruling by Justice Eileen Branston today on Bank of America's suit against MBIA, or MBIA's suit against Bank of America. And it's not clear to me which way that's going to fall, but it could raise the costs of litigation for Bank of America going forward.
When I look at your coverage universe here, you look at Goldman Sachs, Morgan Stanley, JP Morgan Chase, as well as Bank of America. You have buys on those four stocks at the moment. You've got hold on Citigroup and Bank of New York on Mellon, right, which is the one that you're mentioning in terms of lawsuits announced yesterday. When do you actually go in and buy the ones that you like? Because you wouldn't recommend it right now.
No, I think patience right now is the right way to go, and sitting on the sidelines and letting some events unfold. I think November is shaping up to be a critical inflection point for making some decisions. And the reason is in November you have the super committee on the budget deficit decision. I think that's November 23rd. You have the G20 meeting on the Basel III capital rules November 3rd and 4th. You have the Greek debt restructuring default, whatever you want to call it, likely to be decided sometime in November. And then you have a very important court ruling on Bank of America that has implications for their mortgage liabilities. That's November 17th. So I think those things are going to help us make better decisions at that point in time.
And right around the corner, of course, is earnings season, right? Starting with JP Morgan Chase. So which of these banks at this stage, prior to that earnings report, do you think is the most undervalued?
Well, they're all cheap on the measures you highlighted. And if you go back to March of 2009, they bottomed around 0.4 of book, or 40% of book as a group. Some sold much lower. So they all look very cheap. The earnings aren't going to support a bullish argument at the moment because the third quarter was full of dislocations, as we saw from the UBS announcement yesterday. But I think in terms of the strongest balance sheet and the ability to produce earnings even in tough times, JP Morgan sort of emerges as the best idea.
And let's take a look. I want to mention the credit default swap market, because sometimes credit default swap market is quite quiet, right? We don't see a tremendous amount of volume. But really, over the last few weeks, we have seen a tremendous amount of activity with swaps hitting record highs on many of the big names, many of those that you cover. To what extent, when you're analyzing a company, do you factor in what the credit market is saying about it?
Well, I use the credit default swap market for sentiment, but I don't use it for fundamental determination of their funding costs. And by that, I mean, take Bank of America. When their credit default swaps ballooned out past 440, that was a new high relative to the 08-09 crisis. But if you go back and look at their funding costs in the second quarter of this year versus the first quarter of 09, when we had another crisis, their long-term debt is 114 basis points lower in terms of their cost of funding. There are very fixed income issues that don't reflect what the credit default swaps are saying.
And then let's talk about Citigroup. We just heard Bill Ackman there, perhaps talking up his portfolio a bit, saying he likes Citigroup. You've got a hold on this stock. What is it about this particular company that doesn't put it at the top of your buy list?
Well, I think this quarter will show a couple of things. One is that they're not immune to the credit crisis in Asia and the emerging markets in Europe. And that's what is unique about them versus other U.S. banks, is they have this international platform. The second is how difficult it is to sell off legacy assets, because they have Citi Holdings, their bad bank, if you will, similar to what Dexia is about to create. And they really hit a rut in their ability to downsize that bad bank because of the difficulty in selling assets. And now you've got a number of other European banks that also want to sell assets. And I think, three, you're going to see that their expense structure is still very high relative to the shrinking revenue base in this environment. And they're not in a position to do much about their expense structure because they need to invest to rebuild their franchise.
All right, Charles, we have to leave it there. Do appreciate your insight into the financial sector. That was Charles Peabody of Portales Partners at Bloomberg Best. I'm Morgan Stanley.